Hi everyone, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Also, I just let you have a look at the disclaimer. I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These can be long-term or short-term in their duration, and are normally stories and narratives based on fundamentals or technicals that increase in decrease in importance over time. Our goal is certainly to break down all the market jargon and complexities that we read about. So if you do have any questions, please do ask them along the way, and we'll be more than happy to answer those, or at least look at them after the webinar finishes. This week we will look at the markets, how they're set up currently. We'll focus on the dollar, its correction, and also the risk event later on today, the FOMC minutes. We will look at the DXY as well and technicals around that. And then some of the other technicals on risk markets around US indices, so the S&P, the Nasdaq, and also we'll look at the DAX as well, the German index, which is really flying in the last few weeks. And we'll look at also a chart we'll bring in about some S&P seasonals, which we're sort of towards the top end now. I said we'd look at gold and oil, especially in the news recently after its dramatic fall and then quite sharp pullback from the lows. And then if we have time, hopefully we'll just briefly touch on the euro and also sterling and the RBNZ actually, which was 75 basis point hike from them overnight, and a historic hike actually, and quite a hawkish statement, and some outperformance that we're seeing in the Kiwi dollar so far today. Okay, global sentiment at the moment, it is fairly decent, fairly solid. Let me just pull up our first chart that I want you to have a look at. Yeah, we've rebounded quite nicely this week after we saw some doji prints on the weekly charts in the S&P and the Nasdaq last week. We'll look at those in due course. Of course, it's Thanksgiving tomorrow in the US, so it's a holiday shortened week really. We won't get very much activity at all Thursday, Friday. We've had sort of declining volumes actually through the week, and we've also got little, not very much top tier data really, and a few new catalysts really have been evident this week. The main drivers certainly remain the Fed and where the US inflation is heading lower. And also then we have obviously these China concerns around the zero COVID policy and obviously the reopening of the economy. There seems to be quite a lot of evidence in China that the rising infections recently are starting to, well, continue with these restrictive measures really. Reports, especially after the first official COVID deaths over the weekend, actually, those are the first deaths in months actually. Still real concerns around, well, the hope for China reopening really. Although in a way markets are sort of looking beyond this. There is some speculation actually recently overnight actually about China loosening potentially its regulatory grip on tech companies, and that would really give a lifeline to the battered sector really, the battered tech sector. So sort of markets kind of, as I said, still have the zero COVID policy in the background really, but trying to look beyond that, and generally global sentiments rebounded quite positively. We note the VIX, this is the chart that you can see here, fell for a 5th consecutive day. We're slightly up today, but 5 consecutive down days. And it's sort of much closer now to its long-term average, which is around 20. Just pull up the weekly chart, you can see If we go back here, then 20 around here, look, is generally the long-term average. But if we pull it back actually to there, so you can see that, and obviously then these sharp, massive moves higher on the pandemic, and then March 2020, of course, and then sort of periodic episodes of high volatility. The last one we saw sort of back end of September. So the VIX enjoying a few sort of days lower. If you remember, the VIX is a volatility gauge. It's the so-called Wall Street's fear gauge, if you like. It's basically an index representing market expectations of for volatility over the next 30 days. And the index is derived from prices of S&P 500 index options, which have near-term expiration dates, if you like. So just basically a fear gauge, just a gauge on market sentiment, and you can see that falling quite a lot really since those highs, as I say, back end of September. So something to note there for market sentiment in general. Regarding the outlook for Fed policy, we've had a lot of Fed officials. Recent comments from them really have suggested that the terminal rate views are really coalescing around a peak rate of 5%. That's up from around 4.8% after that soft US CPI data. And money market's really pricing in something close to that 5% level in recent weeks. There has been some variation across the Fed speakers, but really the take-home point, the key takeaway from this recent Fed messaging has generally been that, well, more work needs to be done by the FOMC. The risks of probably doing too little outweigh the consequences of doing too much in terms of raising rates. And that means then that Fed policy needs to remain restrictive for some time. And that we've not really seen this cycle's peak in the Fed funds rate. Really, then we'd need to see a succession of weaker CPI prints, and that is especially the case of the labour market is still historically pretty tight. And really until the slack in the economy increases, then the Fed will want to keep financial conditions tight, and that requires the market to remain focused really on upside risks for inflation and for policy. And as I say, we've had a lot of Fed speakers. Recent example, Boston Fed Collins kind of joined the growing chorus of officials that we've seen, just reshaping these market expectations towards that 5% peak rate mark. She said rates need to rise further, and even kept the possibility actually of another 75 basis point hike. That would be the fifth in succession, but just as other speakers as well, she put the focus on how high rates ultimately need to be instead of this pace that the market had been focused on. As I said, the main event today will be the FOMC minutes. If we just pull up this chart here, we can see well, the price action around that Fed meeting on the 2nd of November. If you remember, price action was really quite notable really during the meeting. Markets kind of U-turned from being quite positive, the dovish tweaks in the statement language about the time lag of monetary policy and the cumulative effect really of monetary policy, all this tightening, and that potentially they'd slow down and wait to see what effect that was going to have. That was the language in the statement. Stocks went bid. They were up, I think the S&P over 1% at the time very quickly, and the dollar yields sold off, the dollar sold off. But then quickly, very quickly, once Fed Chair Powell appeared for his press conference, he really changed this, decided on this shift really, if you like, in the narrative from the size of the rate hikes to really emphasis on the peak terminal rate. And then you saw markets, and you can see on this graphic here, yields then popped higher, jumped from the lows, while the S&P and risk assets generally, they generally got sold into as Fed Chair Powell really emphasized, was trying to emphasize that generally the FOMC remains quite hawkish. So concentration, focus on the minutes this evening, really. If we get any more detailed talk around policymakers wanting to take their time after so much tightening, so much policy rate hiking, then the dollar correction may continue to struggle. And then we would see another rally in risk assets and stocks. Obviously, the flip side would see a Fed still strongly determined to beat the inflation and more indications of this theme of higher rates for longer. And that would probably give the dollar a bid, and the correction may slow up in the greenback. Interestingly, there's been a lot of focus as well on the dollar and questioning really if we've seen peak dollar really. The DXY, that's the basket of 6 major currencies against the dollar, with the euro being the preeminent weighting in that, around 56 or 57% or so. The DXY has fallen around 4% so far this month, and that leaves it on track actually for the biggest monthly fall since September 2010. Let's remember it's still up around 10-11% or so year to date as a whole. But going forward, certainly the key data after potentially these minutes will be the November jobs report. That's on the 2nd of December. The following week, then we get the following couple of weeks, we then get the November inflation report on the 13th of December, and that's a day before the last Fed meeting of the year on December 14. Yes, so concerning the dollar then, you've seen this big rebound from the lows by many of its peers as the dollar has corrected, and then it's sort of stabilized. We'll look at the DXY charts shortly, but you can just see some of the percentages, big major moves from the lows against the dollar over the last few weeks. There has also been some emphasis on yield curve inversion. That's been grabbing the headlines, basically because the previous times that the yield curve has inverted this much, then that's preceded pretty much every US recession for the past half century. And they typically indicate that investors think higher interest rates will crimp economic growth. We should say or add a caveat to this is that certainly this inversion focus, it doesn't tell us the timing of that recession, and historically it tends to follow a year after the inversion, but also could be up to 2 years away. So that variance is quite large, and there are occasional false positives just to mention as well, because we know there's a lot of focus generally when the curve inverts. And now especially where that's reached sort of the widest level. If we looked at, say, the 2-year Treasury yield against the 10-year Treasury yield, that's generally the most widely watched, if you like, divergence that you look at between the 2-year and the 10-year. That's been under the spotlight because that reached the widest level since 2000. So 22 years or so, and then also a lot of the curve, if you look at 2-year against a 30-year or other variances, divergences, I think almost more than 70% of the yield curve is now inverted, and that's the highest since late 2006. So what does all this mean for the dollar? History generally tells us that it doesn't fare all that well in the early stages of US recessions. And then going forward in the nearer term, if you like, economic headwinds may keep the dollar tone more defensive as we move into the first quarter of next year. So, okay, if we just look at some of the technicals now, bear with me 1 second. Let's firstly look at the DXY. Sorry, just before we actually look at the DXY, one other area actually of interest we think is position adjustment, and that's been a major factor in this dollar correction that we've seen. It was called, I think, the most widely the most widely followed trade for investment banks, hedge funds, all most of this year. Obviously, the last weeks or so, ignoring those last few weeks, but up till then, being long dollars was the most crowded trade on the street, really, in the city. And then we've had this position adjustment and then this correction in the dollar. And if we look at the CFTC report, so that is the Commodity Futures Trading Commission report. Basically, they publish a analysis of futures positions every Friday. Commitment of Traders report is called, and that's a gauge really of how big market players are positioned in the futures markets, and really it tells us. Well, it takes a net long and short positions taken by both speculators, speculative accounts, if you like, but also commercial companies, traders, banks, hedge funds, the real big players, how they're positioned in the market, and really you can then see it tells us around how market sentiment really is positioned and potentially is used as a reversal indicator as well. So that's the CFTC report. That's showing us really that traders have trimmed their bets on a stronger dollar to the lowest level in a year. And I know that some measures by a few banks are showing actually their first net short in the dollar since early last year. Interesting as well, just on that, the euro's been the major driver of sentiment and positioning versus the dollar. That actually last week saw the biggest bullish bet on the euro since June 2021. But yes, back to the chart, the dollar, we can see the DXY here sort of finding support at the June high around 105.78. You can see there we dipped below it briefly in the middle of this month, but then sort of stabilized a couple of up days really, and then yesterday's pullback just sort of into no man's land really. As we've said, not too many catalysts this week for strong market direction. So we've got support then still at 105.78 or so, along with this rising moving average. That's a 200-day moving average at 105.22 as well, reinforcing that 105.78 levels or zone, if you like. I've also put on there the August low around 104.63, looks like. Yep, 104.64, sorry. So just some levels of support below there, and then resistance looks like above. That's the 100-day moving average, this line here at 109.05, and then you've got the 21-day moving average as well, 109.19, and then you've got that sort of long-term support line that you can see there from April, which sort of will turn into resistance potentially if the dollar gets bid up into these simple day moving averages. If we look at stocks now, risk assets, the S&P, I was talking about the doji, and you can see there that doji candlestick there. That really represents indecision between both buyers and sellers. It's kind of a neutral indicator, if you like, as prices open and close near the same level that you can see there on that candlestick. And then if we look at the daily, you can see obviously this big bounce from those lows in October, where we got below 3,500 very briefly, and then pushed nicely up around 14%. I think now the bounce from the 3,500 low. And you just see we paused around the 4,000 level, key psychological level. It's also the 61.8 fib level, just above there actually of this August move down. So we pushed up, touched above there, and then consolidated around the 100-day moving average at 39.13. And then yesterday, potential breakout really of this consolidation pattern. We really need to get above 4,028. You can see there that 15th of November high, and then also the 4,000 level really as a key psychological level, really, but then we have that fib level reinforcing it as well. If we do break above, then you've got the widely watched 200-day moving average at 4,062. You can see there it capped prices in August and also back in April, really. That will be grab the headlines, really, if we approach that level, 4,062 as we see it, the 200-day moving average in the S&P. You've also got that long-term trend line resistance just above there that you can see the dotted line as well. So some key levels to look at if we do push higher for the S&P 500. The NASDAQ, not such a big bounce from those lows. 100-day moving average, you can see 11,938 on the NASDAQ 100 cap upside. And then also you've got the 50% midway point actually of the move of this August sell-off, if you like. The 50% marker is just above 12,000. This is the NASDAQ 100. Then let's look at the Dow. You can see a decent move off the lows. The lows in October, just above 10,000 on the Dow. And we're now actually up to around the 20% level, the rebound from those lows. So getting into bull market territory, wouldn't be surprised if that grabs a headline soon. We're very close to that, I think now, 18% or so last time I looked. And the breakout really potentially will be capped again by the 100-day moving average, now at 11,511. Let's pull up the Dow. Sorry, we were looking at the NASDAQ there. So NASDAQ upside capped still by the 100-day moving average, 11,511. The 200-day moving average much higher. So we haven't had that sharp rebound as we've seen in the Dow, certainly in the S&P. And you kind of think that for those to push higher, then tech needs to lead the way because it's been the laggard, really. Let's look at the Dow here. You can see this big bounce from the lows below 29,000. As I say, up to around 19% now from those lows. And really the key level for us, the August high, 34,281, being a key level for the bulls. Especially if we can hold above this, which looks like we're breaking out then of this sort of bullish consolidation pattern, heading towards 34,281. If we then pull back, well, potentially 35,000 on the horizon if we can break that August high in the Dow. We said we'd just touch on the DAX actually. Again, also really interesting, massive bounce really from the lows in the DAX, the German, the key German index. Again, consolidation around the highs and sort of dragging on slightly. Looked as though we were breaking that on Friday. We're just sort of edging higher really, 14,400, but so a small pullback really, sort of teasing us really, and potentially, yeah, really important levels if we can't push higher. Sort of narrower days in this sort of long-term or medium-term uptrend, really, we kind of think we would see a sharp break higher. As you can see that we saw then, we had a couple of small days after getting up to the 200-day moving average, and then a big blast higher, and then sort of consolidation after that range expansion, if you like. But we're edging higher still. You can see the June high there is at 14,741 as a potential for bulls, and then you've got the halfway point of this year's move actually is good support, probably at just above 14,000 there. You can see that. But certainly European stocks have really been quite strong. Sentiment has certainly been lifted by hopes that the pace of ECB tightening will slow, by signs really that the Eurozone energy crunch so far kind of avoided the worst of outcomes, really, amid high natural gas storage levels and also more efficient energy use potentially. But certainly headwinds remain, and we've seen that in the Eurozone PMIs today, still remaining below the 50 level, so still remaining in contractionary territory. Hopefully we'll just look at those in a bit shortly, but I said I'd look at oil, and that's certainly been grabbing the headlines recently. Brent and WTI, they were looking as though this is the Brent chart, actually, Brent crude. So oil really looked as though it was rolling over, mounting fears about weakening fuel demand in China, and also recession fears with that yield curve inversion, all kind of outweighing concerns about Russian supply potentially falling next month when these tighter EU sanctions on its crude exports come into force on December the 5th. That's kind of a live story, actually, because there's ongoing talks today actually around Russian energy price caps. But we could see that crude lost around 9% last week. WTI lost around 10%, biggest losses in WTI since March, actually. And we dropped sharply, actually, down just below that key September level of support around 82.46 in crude. We touched just below, I think, 82.30. Yeah, you can see. But then had this real strong candlestick. You can see a hammer candle, really, which is where we trade much lower than the opening, but then we rally during the session and we close pretty much where we opened. So kind of strong rejection of those lower prices that you can see at the start of this week. We're down again today, actually a couple of percent or so, which is probably due to the Russian issue that I mentioned. I'd need to check those headlines, but yeah, be interesting price action from here. I've got in the October 2021 high around 85.79. You can see first support, but then, well, initially we had that rejection of these prices lower, but 82.46 is a key support level for oil going forward. The downtrend really was as well put in place by the IEA, the International Energy Agency, recently, citing a bunch of headwinds for oil demand going forward. That included China's persistently weak economy, obviously the energy crisis in Europe, if that flares up again, and then obviously recession odds and potentially dollar strength. So those are sort of more longer term drivers of the oil market that actually led the IEA to cut its forecast for global oil consumption for next year. Yeah, will be interesting for oil going forward. Obviously a driver of inflation as well. That I should say that rebound happened because of Saudi Arabia quickly denying reports that OPEC Plus was looking to increase its supply. I'm not sure whether we've had some headlines around that this morning as well, but yeah, certainly a driver to look out for going forward. Their meeting, the start of OPEC Plus meeting at the start of December, and whether we get continued denials by the group of any output increases or not. I know that there was as well a larger than expected draw of crude inventories yesterday, gave a little bit of a bid. So be interesting price action around these lows going forward. Okay, we'll briefly look at gold as well. Traded lower for 4 straight days, and the market was potentially looking at 1725 support. You can see here. A stronger dollar driven by the FOMC is more hawkish record, really, or at least the stabilization in the dollar and the slowdown in that correction, kind of weighing on prices. We also had gold futures actually were bought at the fastest pace since June 2019 during the 2-week period up to November 15. So in the run up to last week's failed bid to break above 1800 that you can see here, then potentially we see those longs liquidating from some of the funds and potentially some more downside. That during the same period, actually, holdings in bullion-backed ETFs, they continue to fall actually. So kind of signaling no appetite really, or very little appetite from longer-term focused investors to get involved in this push higher. Going forward, longer-term drivers, obviously the dollar and treasury yields. They've kind of stabilized around on the 10-year treasury yield around 3.75% or so, potentially capped or upside being capped just above at around 3.8% or so. Tracking sideways really US treasury yields at the moment. So we'll look to the Fed minutes potentially as a move for these and then as a driver for gold going forward. Technically, yeah, 1725 we have as a sort of support zone, and then these simple day moving averages, 100-day moving average at 1711 below that, upside capped certainly by 1800, and the recent highs around, well, below that 1786. Okay, I said we'd look at euros and sterling and also Kiwi. First of all, let's have a look at the Kiwi dollar overnight. Bit of outperformance really in the Kiwi. The RBNZ, they raised rates by an historic really 75 basis points, took the cash rate to 4.25%. That was generally expected by most economists. I know the market had priced in around 67 basis points, so not the full 75 basis point hike. So a little bit of a split there. But the overall communication by the RBNZ was relatively hawkish. They even talked actually of a 100 basis point hike, discussions around that, 75 and 100 rather than a 50. And new forecasts from the bank, they raised the peak rates that they see to 5.5% actually next year. That's from their prior October forecast of 4.1%. So a big jump in where they see peak rates. Caveats here, the bank sees the economy entering into recession actually in mid 2023. So really interesting to see how they go from 4.25% to 5.5% in a few months. Certainly the clear recent surprise in Q3 underlying inflation up to 7.2% that print, plus also the rise in inflation expectations really kind of has forced this biggest rate hike in the bank's history. And as I said, Kiwi has been slightly outperforming today, slightly off its lows now. You can see the Kiwi dollar chart here. Again, bullish consolidation pattern potentially, and it looked as though we were breaking higher. But 62 a key level here, 62.06, that sort of range high, if you like. So we need to break above there really to challenge really that 200-day moving average at 63 or so. If we do break out of this consolidation pattern, support really seen at probably 60, 64 or so, near-term support 60, 87, 60, 90 or so here. If we do break down of the lower end of this range. That's Kiwi dollar. Always, obviously, bear in mind global risk sentiment generally, and obviously China news as well. Key drivers of the Kiwi generally have been and will be going forward. Eurozone, euro dollar as well. We got Eurozone PMIs. Just bear with me 1 second. Yeah, Eurozone PMIs. Just pull up that chart now. You can see this is the euro dollar. We got the PMIs, as I say, survey data released earlier today. Prior figures for October, they indicated that economic activity was slowing further. So markets quite keen to see, economists especially keen to see, assess this latest health check, if you like, with an eye on next year's outlook. The composite number for the Eurozone, that came in at 47.8 in November, so slightly better than October. And inflation pressures look to be fading due to basically easing supply problems, but also this imminent recession. New orders, they continue to fall actually, and the composite at 47.8 certainly still remains in contractionary territory below 50. So yeah, across the Eurozone in general, not too much major other news to shift the economic narrative, if you like. Inflation is still high, 10.6% in October, and expectations for economic conditions to remain weak. Regarding ECB and the policy, the December meeting, not too far away, mid-December that is, increasingly likely that the bank steps down from the 75 basis point hikes to 50 basis point increases. Hawkish policy makers really not doing too much to talk up a bigger move. So potentially 50 basis point move in mid-December at the ECB meeting. For the euro then, decent bid really. Eurozone stocks, and we saw that in the DAX, the big rebound, certainly relative to US market returns is giving a headwind to the dollar. Yes, general sort of better sentiment slightly on the energy issues, as I've mentioned, with the better natural gas storage and energy efficiency as well. Giving a slight bid to the euro, off its lows certainly, and above parity as well. The upside looks capped by the 200-day moving average then. It's capped already, the upside, once before, or a few times now, and that 200-day moving average now comes in around where 103.95 or so. We've then got the August high at 103.68 as well to look out for, and that as well sort of a little zone of resistance for any upside to euro dollar. That high was 104.81. If we do break above there, and then we probably move towards sort of the June highs, 106 or so area. Otherwise, support comes in at the 38.2 level of this the year, actually the year's downtrend. That 38.2 fib level at 102.84 may offer some support, and then you've got sort of Monday's low at 102.22 as well for support before potentially then we go lower below 102. That's euro dollar. Just briefly, let's touch on sterling as well. Sterling, the pound kind of weathered a lot of risk events last week. We had a load of data, CPI data, retail sales, and the employment figures, but then also this autumn statement, and it weathered that pretty well, really well, considering a lot of that was leaked certainly. Much of the anticipated fiscal pain has really been pushed back until after the next election. Jeremy Hunt, the Chancellor, the Finance Minister, basically calculated that calmer financial markets and the announcement of certain tax rises basically meant he could push back some of the tougher spending decisions, and that was without really sparking any fresh crisis of confidence, if you like, in UK assets, obviously, that we saw in September. Key then going forward will be for sterling really any foreign flows back into or out of gilts. So those are the UK government bonds, which obviously flared up the whole crisis in UK assets. So any inflows into or outflows in the next few months really will give us a stronger sense of if the pound's potential to stage a more sustained recovery, probably above 120 in cable, looks likely. Otherwise, certainly a grim outlook on the domestic front for the economy. Expected to remain in recession through to 2024, really, as historic inflation pressures see UK households face the largest fall in real wages in 6 decades, declining 7% into 2023, 2024. So grim on the domestic side, but certainly for the sterling against the dollar, certainly, of course, you've got to check out dollar dynamics, and then also sterling kind of rising on global risk sentiment generally. That's been the driver recently. And then technically, then if we look at the chart, you can see this decent push up, obviously from the spike close in late September, and sort of where are we now? Consolidation phase, really, just below 120. The recent high at 120.28. Really, we need to push above there to sort of get this new sort of range, 120.20, 125 possibly. But really, if we move lower, probably initial support around 117.62 or so, then support then looks like being at 116.43, 116.39. If we do possibly move lower, global risk sentiment a key driver, of course, and then the Bank of England meeting actually mid-December as well. That's on the same day as the ECB meeting on December 15. That's the day after the Fed meeting, which is the day after the US CPI reading. So mid-December, key time for markets generally as we head into the new year. Okay, we've covered quite a lot as usual. Hope you've enjoyed that, and we look forward to speaking to you in a couple of weeks' time.